What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Lindner. Hope you had a good week. We're going to wrap it up here on Friday. Take a look at some of the breaking news out there with the China stimulus. All of the China bulls are back on Twitter saying how right they were, but we're going to cover what's going on in China and how to look at it. We're going to take a look at GDP revisions. The third revision for Q2 GDP came out this week. Some funny business going on there. So we're going to read through a Zero Hedge article on that, and then we'll look at some Bitcoin charts. So let's share my screen and jump right into it. If it will come up, there we go. We'll start here, of course, at bitcoinandmarkets.com. I did just put out a premium post for premium members over there. So if you guys want some more price talk, you can sign up for that. Also, make sure you're a member of our email list. Also, I am going out on YouTube, Rumble, Twitter, and Telegram. So trying to get the YouTube subscribers up. If you're watching on Twitter, we usually get a couple hundred concurrent viewers on Twitter. Jump over there to YouTube and like, comment, subscribe. I appreciate that. It helps me grow the channel. Okay, so that is the website. Where do we want to go first? Let's go to some China stuff. And I'm going to try to make this bigger. Stand by. I don't know why it doesn't like it. Okay, that's going to be better, I think. Okay, that's a little bigger. Okay, so we have all this China stimulus. And if you guys have been following my content, you know that I have been talking about China ad nauseum for how many years now? Years and years. Going back pretty close to COVID, I would say 2020. When did I go on to FedWatch for the first time? I think that was in 2020. But I have been talking about this China bubble popping, China's economic model being over, their demographic problem, their resurgence of, Marxist Leninism going on with Xi Jinping becoming emperor. And nobody wanted to believe me. There were so many people that are China bulls out there, and China bulls are back because of this stimulus. So this is from Jerome Blockland, and we have a list of what they did here for the stimulus. So they just went all in on stimulus, sending Chinese stocks 4% higher. China's central bank, this is what they did. They lowered the policy interest rates, but not their main policy interest rate. They lowered some of the other ones, like they have a 14-day rate, and they lowered that. We'll take a look at that chart here in a second. And they signaled more cuts are coming. Cut rates on over $5 trillion in mortgages. Wow. Eased rules for second home purchases. Lowered the required reserve ratio for banks, freeing up fresh liquidity. Pledged over $100 billion in equity market support. And they stated policymakers were studying a stock market stabilization fund. These measures are astonishing in itself, but the fact that China opted to announce them all at once is a significant deviation from previous years. All this means is China, again, unlikely to stay within its budget deficit target of 3% of GDP, and unleashes a massive slew of liquidity that will be felt globally. This is outright bullish for all risky, liquidity-sensitive asset classes like quality stocks, gold, Bitcoin. In effect, it will also provide upward pressure on inflation, which has hovered just above zero for months. Okay, so what's my takeaway from this? My takeaway is this, and let me share this tab. So this was my tweet this morning, and I said, don't concentrate on the flash in the pan reaction to massive stimulus. So there's a lot, like he just said, like Jerome just said, everyone's thinking, oh, this is a huge liquidity injection, and it might be, okay? But what's the reason that they needed that? It's not like they're just kind of steady state, ho-hum, everything is going flat, and they're going to pump all this liquidity in. No, they were doing it because it was necessary. Okay, he also said that it was outside normal for China to do. So why would they do it all at once? Because it was probably way worse than any official numbers telling us. It was they had made it illegal to short stocks, and stocks couldn't find a floor. I mean, just look at this Shanghai Composite. Look at that. And it was illegal to short stocks. So I mean, things were really really bad over there, so bad that they went outside the normal. They did all of this emergency stimulus all at once, and it's kind of like shock and awe. People are standing back, going like, "Wow, this is so much liquidity. What's going to happen?" My prediction is that this will last for a while. It will run for um, a month out to 3 months. So we could be revisiting this big turnaround towards the end of the year. All right. But it's a flash in the pan. It's not going to last. Massive stimulus doesn't fix their fundamental deterioration. They are trying to boost domestic income, or sorry, domestic spending. And you can see that with lowering interest rates and stuff. But remember, lower interest rates, do they stimulate spending? No. Lower interest rates actually hamper spending. They make it, they confirm a market signal. So in a free market, rates will fall as money is becoming tight. So if you lower interest rates, it sends the market signal that money is tight and people don't spend. They're not going to get out of this. They might be able to backstop some balance sheets, but they're not going to be able to change the fundamentals that are wrong with this economy. So that's the first one, spending. Second one is demographics. They're losing 1 million people or more a year. Japan is losing close to 1 million. So China, which is in a much worse situation, is probably losing 4 or 5 million people a year out of their economy. This has drastic reverse network effects as consequences. And how do you stimulate your economy when your population is crashing? How do you stimulate consumer spending when your population is crashing? You have fewer people to spend. That's the problem. A lot of people don't understand about demographics. Most people think demographics is a supply issue. Oh, we're not going to have enough workers. No, you will have plenty of workers because people will want to work to feed themselves. So you'll have plenty of workers and you'll have automation. But I think automation is going to go out of fashion because as jobs move down the specialization ladder, which is going to happen as we have reverse network effects, um, that automation is going to compete directly with those people. And so I think we're going to have reverse of the automation trend that we've seen over the last 40, 50 years. But so you have the demographics, you have fewer people. Oh, demand. So yeah, the production is no problem. The problem is the demand. The problem is that you have fewer mouths to feed. So why would you, very, very simple example, we can just use agriculture. Okay. If you have to continue to grow and produce things because that your economy has to grow. You want your economy to grow. You want your GDP to be positive. So that's like increasing the yield of your agricultural sector. But that doesn't make sense if you have fewer mouths to feed. You guys track on that? So it doesn't matter if you have robots because you just have fewer people demanding fewer things from robots and they become uneconomic. There's not enough customers to pay for this. And so anyway, that is also what they're facing. And on number 3, they're facing deglobalization. Trump's coming back. What did he say about tariffs? They're going up. Doesn't look like anything, it doesn't look like international relations are on a path towards being fixed anytime soon. They're still on a massive path towards deterioration. And China's economic model is based on exports. How do you export to a world that's also losing people? How do you export to a world that's in recession or depression or in credit collapse? You don't. And so those 3 things Yeah, this is big stimulus. This is big news. Big news. But if you read beyond it and you put it in the right, you seed it in the right understanding of the situation. This is desperation by the CCP, absolute desperation, and it will not fix anything. You cannot fix this fundamental deterioration. The deterioration will only get more entrenched because if you bail people out, give them cheap loans, subprime loans, or whatever, it doesn't make them more productive. It doesn't make them. It doesn't allow for malinvestment to be wiped out, defaulted on, and have creative destruction in the economy and reset. It entrenches all of the bad activity and brings more bad activity. So no, this is not going to work. I think that there will be a couple months maybe where we get a big boom. We might see this in Bitcoin, a God candle up to 100K in coming weeks, but it's not going to end up fixing anything. And it's going to quickly reverse in China and reveal a big fat waste of money. That's what it's going to reveal. All those billions of dollars spent. Here is another chart of that, the 14-day reverse repo rate that I was kind of talking about. And this is what they cut. Now I have to zoom out. So one more time. Actually, I have to zoom out to 90%. Okay, so you can see just cut. And it's not all at once. They've been cutting this whole time. This doesn't have a year. These are, what are these? S and D, J, September, December. Must be January. These are months down here. September is this month. So look, this goes back 1, 2, 3, 4, 5 or so years, probably to 2019, pre-COVID. This was the COVID cut, most likely. But you can see they've been cutting the whole time. What has the Fed been doing? What have other central banks been doing? They were at zero, then they raised rates, and now they're cutting again. China has been cutting the whole time. Why? Because their economy's falling apart. That's why. And this isn't going to help them. None of these other cuts helped. It might have stopped it for a little while, gave them a little bump, and then it returned. Yes, there was zero COVID in here and all that, but this is the trend. Lower and lower, grinding lower. China's over, guys. China's over. I had another one here, and we saw that on the China composite. Okay, so let me check and see if there are any comments out there yet. We will see. Guys, I'm live streaming on YouTube, Rumble, Twitter, and Telegram. It is Friday, towards the end of the day. People just got off work, so they're probably, maybe if you're listening in your car or something on your YouTube. But yeah, make a comment. We'll see what you guys are talking about. Okay, let's move on to this Zero Hedge article. I wanted to talk about GDP. All right, so mystery of upward GDP revision solved. If you guys don't know, they had the Q2 GDP had its third revision. They usually have 3 revisions before the next quarter comes out. And the next quarter is supposed to come out October 30th. So that's the big one for me, is going to be Q3. But they did revise this up slightly, and other people were not expecting this. So something strange happened yesterday when the Bureau of Economic Analysis released the final estimate of Q2 GDP data. As part of the release, Biden's Department of Commerce, run by Gina Raimondo, which also runs the BEA, reported that GDP since 2020 had been revised markedly higher. Okay, so there's the first part. Even though banks such as Goldman warned of the expected, Jesus Christ, can I read? Even though banks such as Goldman warned of and expected a significant negative revision to historical GDP numbers. We're going to skip all these charts and just take a look at the important ones. So, what happened? Recall about a month ago, questions started to swirl around the record divergence between gross domestic product and gross domestic income. Now, this is a topic I have been talking about on the show here more often over the last few weeks, that GDP is imperfect. Okay. And one thing about GDP that's imperfect is the way that it measures government spending at like 1-to-1 with private spending. So government output versus private output. The bad thing about that is that government spending is less efficient. So it's not 1-to-1. It should actually be, there should be a handicap for government spending of 15% or something like that, right? That would majorly change the way GDP is calculated. But another way that people calculate this is gross domestic income. And I think Jeff Schneider has talked about this recently as well. And there was this big gap opening up. So let's open this. You can see GDI is below zero. And Goldman and others were expecting this revision to put GDP lower towards GDI and catch down. You can see that happened here. Going back to the great financial crisis, GDI was going down. It was negative, and GDP caught down with it. See that? Didn't really catch down too much here in the middle, and then we had COVID. So people were expecting this GDP to catch down, and that is a totally legit expectation. Okay. Which, unlike GDP, also captures various interest payments, mostly to and from the Federal Reserve. Okay, so that's the difference. Ironically, back in September of 2023, JP Morgan expected that GDP would catch down to GDI. So 2023. So yeah, we're back. Where was 2023? This is 2024. So maybe it's right in here, something. And it kind of did, but now it hasn't. Resulting in a much weaker GDP print. That did not happen because the Biden admin came up with a last-minute stick save that revised historical data to make it seem the U.S. was stronger than previously thought. Now, if you guys know my content, I'm not one that is big into these type of theories. Usually, these will get fixed in revisions, or there might be a slight deviation from reality, like politically, but overall, this is not. There is not any like big conspiracy to make these numbers different. But in this case, it doesn't have to be a big conspiracy. They pinpoint it on one person. So let's continue reading. Fast forward to this week, Goldman was looking at the same gap and also at the divergence between various GDP components as reported and the revisions, and also expected that historical GDP would be revised much lower, also catching down to GDI. That too did not happen because the Biden admin, well, it pretty much did the same thing. Again, what did happen is that not only was GDI revised sharply higher, effectively closing the record divergence between the two series by boosting various interest income assumptions of GDI. Okay, so that's that. There's more. After the release of today's personal income and spending data, we found just why Goldman was so wrong in its correct assumption that US GDP should be revised lower based on historical data. The reason for Goldman's erroneous forecast and unexpected boost in the US economic growth is because the Department of Commerce head Gina Raimondo, the same person who 1 month ago told ABC that she was unfamiliar with the Bureau of Labor, which had just slashed historical U.S. jobs by over 800,000, and one of the most political operatives of the Biden administration, decided to drastically revise the two most important data sets propping up the U.S. economy: personal income and personal spending. Imagine if this happened in China. She'd get a medal. Definitely get a medal. All right, let me take a look at comments. Dex Invictus back with us. Brandon, did you see Tepper's comments on China? I did. I also saw a replay of him in like 2010 or something. saying the same thing about the U.S. economy. Um, I don't know. He doesn't strike. I mean, I know he has a good track record and stuff, but uh, just kind of a cheerleader. And you never know what they're doing on the back end. Like if there's somebody that comes out repeatedly, like once a month, they're on the shows. Like these would be people like Stan Druckenmiller or Tom Lee or Larry Fink. Even nowadays, they're coming out multiple times, month after month after month, and they're building a case and they're seeming very rational. But then you have Tepper up there saying, "Buy everything, buy futures, buy everything." Like that. That is not a rational opinion. That's an emotional opinion meant to drive the market in a certain way. It's very irresponsible, very, very irresponsible. And so he just seems like a cheerleader, in my opinion. Okay, let's get back to this. First, as shown in the chart below, personal income was unexpectedly revised about $18 billion higher as a result of not just an increase in what the government believes was interest and dividend income, but also government handouts, i.e., personal current transfer payments, receipts, rising over 200 billion, and also a $293 billion cumulative increase in wages and salaries. In total, disposable personal income was revised from just under 21 trillion annualized to 21.8 trillion, and that doesn't seem much, but that's $800 billion. Okay, so here we go. There's the red line, and you can't see it because my head's in the way. There we go. This is the original series of personal income, and this is the revised series. And you can tell how that would make a big difference to GDP. All right. Spending was also revised higher, if to a lesser extent. The August number for personal outlays was revised higher by about 350 billion from 20.38 trillion in July to 20.73 trillion in the revised data, reflecting a reduction in spending on goods offset by much higher increase in spending on services. Okay, you can see that. That's important because this is a trend, and when you compare GDP, right, it's you're comparing quarter to quarter, and if last quarter is revised higher, maybe this quarter will be revised lower, right? So they're all kind of interdependent, and if you have something that affects the entire series like this, it can make things look drastically different than they would have looked. Okay, continuing down. To summarize, disposable personal income after tax was revised 3.8% higher, while personal spending was revised higher only half that by 1.7%. And since the difference between how much you make and how much you spend is also called savings, we can finally get to the bottom of how the US economy magically grew in the past several years instead of shrinking more. I mean, I think the economy did grow. It just not nearly as much. So instead of 3% annualized, maybe we should be down at 1% annualized. But yeah, it's just these metrics are not very good. It turns out that when some bureaucrat in Gina Raimondo's Bureau of Economic Analysis decided to click on a mouse button in recent weeks, perhaps in political response to the dramatic plunge in revised jobs, Americans suddenly became much wealthier, if only in some department commerce spreadsheet. Yes, but this will eventually be revised. It'll eventually be found out because if Americans are suddenly wealthier and they're not, it's not, the data is not going to match reality. So that's what a lot of these bureaucrats and these Marxists think, is that power makes truth. All they have to do is tell you you're wealthier. They have the power to do this, and that will somehow manifest itself as reality. But it's not. Reality is the base, and your numbers are not reality. They are propaganda or, whatever. So that's how they think that they can make you wealthier on paper and it will magically become true because power is everything to them. You see, when subtracting the revised personal spending from the revised personal income, what you get is the revised savings of US customers, which, as of today's, uh, how do I say that, second revision, has almost doubled, rising from 600 billion in July to 1.1 trillion in August. Wow. Okay, so you can see this. This is the kicker chart. Old way of measuring GDP and new way of measuring, well, personal savings. So this is a big deal. But what I was talking about too, I touched on before we went live uh, on the pregame show on Telegram, is if you look back here, 2019. I mean, 2019 was not really all that bullish, and we're right at that same level, which kind of makes sense to me. Maybe a slightly lower than 2019. So both of these make sense, and it's within kind of a um, error margin, you know. So this doesn't really affect my overall thesis on the economy. I still think we're going into recession, but it's just something important to be aware of. Okay, so that's all for that post, and let's jump into the charts. So let me bring up the Bitcoin chart, and we'll start there. But let me check the comments. Dex says, China said to the world, please take our markets serious. Yeah, something had to spook them. You know, some piece of data. And the bad thing about faking data, as they do for so long, is you don't know what's real anymore. You trick yourself. Like, you don't have anything real to go on because you've fudged the data for 15 years and added a percentage point of growth every year, or 2 or 5 percentage points of growth, and you don't know what's real anymore. That, on top of being a Marxist, I mean, you don't have a clear vision of what's happening at all. And I just think they are spooked. And something they saw spooked them big time, and they're unloading on the market right now. Um, a lot of people also, they have this vision, all these China sycophants, they have this vision that uh, Chinese are super smart, and they have a 5-year plan. Don't you know, Ansel? They have a 5-year plan. They're so damn smart at this that they can centrally plan where white guys can't, right? Like, that's not the case. They're not special in this way. They, as communists, they're worse. They're worse as, the Western central planners traditionally. I mean, nowadays there are so many Marxists everywhere, but traditionally it was capitalism with some government tinkering around the edges. Now, so anyway, China is not going to be better at central planning than capitalism with government tinkering. Right now, maybe they could be, since we have this problem with in the West as well, with Marxism going all over the place. But bottom line is, China is not special. They can't centrally plan their way out of this. This bazooka will backfire, and their whole economic model is dead. What does that mean? So I'm not as radical as Peter Zion, because I don't think like China will cease to exist or whatever he says. But I do think that there's going to be an uprising, um, you know, Tiananmen Square or worse, and it might succeed. Eventually, they're going to have to break apart. It's just not a naturally constructed country right now, and their security costs are way too high. They don't have a functioning economic system. There's going to be a lot of pain. I mean, there's going to be a lot of pain in the West as well, and in the United States, when we switch our economic model. But China is in a much worse situation. So they can't, they need all this, they need to import food and energy. The US doesn't, well, we do import energy, but we can be energy independent in quite short order. We can feed ourselves, so we're food independent. So the US economy is on a much more stable footing going into a deglobalization event where China is not. China is going to go through massive, massive changes. And this stimulus doesn't do anything to change the underlying fundamentals. Okay, so let's take a look at some of these charts. Here's Bitcoin breaking above this level. I mean, we're above all the moving averages. Here's the 200 and the 50-day, breaking above that 200 again in a much better form. So back here, Point was talking about this on Telegram. You have, make this bigger. You have this time we shot right through. Once we broke the 50, that pent up pressure, shot us right through above the 200-day, and we couldn't hold it. This time we really battled with that 200-day, and now we're breaking above it. So this is a much more sustainable move. We are not overheated, as you can see on the RSI here, which is at 66. Overheated will be 70. But if we zoom out on this on the daily, you can see we can get very overextended. We can get up here to 90 on a daily easily. I mean, when we start getting to 85 or 80 to 85, that's when you have to start thinking about a possible top. So let's see where this 85 was, or this is about 80. Okay, this was right here at this. Then we cooled off, and then we went back up. So yeah, 80 would be overheated, where I would say, okay, let's take a step back and reassess where we're going. But right here, this is like launch pad. This is launch pad for going higher. Now, where is the resistance? Really, the resistance is coming from the different patterns. And we've talked about these patterns many times. Let me just bring them up real quick. So we have, which one is this? This one. So this is the, oh, I only got one. What happened to the other one? There we go. This is the megaphone pattern. You can see we're coming up to the top of the megaphone. Also, if we throw in, instead of the megaphone, we toss in the parallel channel. Where are you? Please tell me I didn't delete it. Is this it? No. All right, well, I'll just draw a new one. So this is kind of the parallel channel that we've been watching as well. And we are right at the top of that parallel channel. Looking at other things, I put out the premium post today, and I'm talking about this gap in here and what that means. This between the structural resistance at the all-time high and the pattern resistance right here. What does this mean? So we talk about that on the premium content. If you guys go to bitcoinandmarkets.com and sign up for the professional tier, you can see what I wrote about that today. But yeah, so that's what I'm looking at for Bitcoin. Hide that now. What else should we look at? Whatever you guys want me to take a look at, put it down in the chat. How about gold? Gold has had a big run down on the day. I'm not surprised that it's down on the day because it's been running so hot. I mean, there is kind of a little bit of room higher after consolidation, but I would like to see a week or two of consolidation before further movement higher. This also, like if the Chinese stimulus, they like their gold over there in China. If there was really all this stimulus and excitement, we would see gold instantly bid higher. But today we actually have a down day, which is not what you would expect. The dollar holding in there above 100. We will see if that turns into a dip or a rip. Dip or rip. I'm going to say it's 51% that we're ripping, 49% that we're dipping. So we will see how that works out coming up here. If you guys are new to my content, I have been calling for a range bound dollar, and that is exactly what we have. I thought the range was going to be a little higher than it is, but has been extremely range bound for the last year and a half, 2 years. So I don't expect a major breakdown in the dollar anytime soon. Let's go to the US 10-year. Well, let's check the Chinese yuan. Look at that. So going down here is strength. And let me bring up the 50-day moving average. I'll get rid of this 200-day. But you can see, well, one, very oversold. But since this is reverse, going down as being stronger yuan, this is extremely overbought yuan. And it can get very overbought, as you can see right here. But this can't go on forever in this direction. This 50-day moving average is interesting. If you just go back in history, it's quite important for their interventions that they do. And trying to stay above that 50-day. Now we're back below it. So we'll see what happens with this. I mean, you would think on a day that you have big time intervention, the Chinese yuan would get weaker. So why is the Chinese yuan getting stronger? Anyone? No, it's because people think that with stimulus, and you can see this in all currencies too. You can see this when the ECB does their stimulus or cuts rates. You can see when the US does this. When you have this stimulus, people think that, oh, the economy is going to pick up and there's going to be more demand for money. So the currency actually appreciates during these stimulus packages, which is an interesting backwards dynamic that most people don't think about. All right, so that's the Chinese yuan. Keeping it moving here. US 10-year. Still following my kind of crude drawing. this limp orange line right here. Interesting that it turned out to be right at the 50-day. So I drew this way back here early September, and it has followed this pretty good. And it probably will continue. I mean, it might go a little bit past and then catch down. But this 50-day moving average is interesting. That is right here on my drawing almost. So we will see how that develops. Of course, falling interest rates means tight money. Money's getting tighter. You're going into recession. Backwards thinking from what the Federal Reserve and what central banks think about today with China lowering rates and stuff. They think lower rates will allow more people to afford to take out loans. But that's not what is the natural market signal. The natural market signal is lower rates mean tightening credit standards, lower demand, less economic activity. Because if the economy, people don't think about this consciously. It's all subconscious. But if you owned a business and you were doing well, you could afford 8% interest rate on some line of credit. Okay. But if your business is doing badly, you can't afford 8%. You don't even really want to afford 4% because you don't want to take out any more debt because you're in bad shape. So interest rates fall when money is tight. Now, the Fed knew this before Volcker. Before Volcker, that is what the Fed preached. And you can look at their monetary policy relative to recessions and stuff. In recessions, they hiked rates. In recessions, the central bank hiked rates, which is kind of totally opposite of what people think today, because we were tricked by Volcker, tricked into believing the omnipotence of the Fed. Don't fight the Fed. They turned everything on its head. We've been backwards ever since. So, yeah, raising rates is actually stimulatory because it's increasing someone's income, for one. And two, it's mimicking the natural market movements of when you have a booming economy. A booming economy, rates rise. And so if you raise the interest rate, It's a natural subconscious market signal to everybody that things are okay, and it works through incomes and it works through other things. So, um, anyway, that's all I have to say about that. I go on forever. Oh, oil first before stocks. Oil up on the day after a big dip. We had news out yesterday or the day before about OPEC uh, starting to repump, starting to take off some of their production cuts because they're losing so much market share to US shale and others. So they are saying, hey, we can't lose this market share. We got to start pumping. And their previous target was about $100 barrel oil. They're giving up on that and they're just going to pump. So we're at 68, 69, and where's the bottom? Nobody knows, but it's a lot lower from here as we go into recession. We're going to get a lot more cheap oil. Okay, S&P 500. We talked about this the other day, and I drew some arrows here. Let's see what these are all about. So I talked about we could see some different. If recession is imminent, we could see this direction coming down. And actually, let me extend that a little bit because this is the level that we would be looking at is important. So yes, breaking that to the downside is what we would need. And it looks funny without an arrow on the end. However, if we have a little bit longer to go until we get into recession, we could see this path. And so far, it's kind of following this path up and to the right. So again, we are in a pre-recession period, but keeping an eye out for imminent recession. I started building this kind of terminology out a couple years back, maybe. And as you're in a pre-recession period, you should see stocks, bonds, Bitcoin, gold, all these things should rally. Okay. In a pre-recession period and not rally really hard. That really hard rally is the culmination of the move. And then you have a going in imminent recession. So from pre-recession, where the economy is slowly deteriorating over maybe 18 months to 24 months, then you get a imminent recession period where you're within a quarter of bad things happening. And that's when you got to kind of transition over to a defensive posture where stocks are going to fall, bonds are going to crash higher in price, lower in yield. And then other things like gold and Bitcoin are going to react differently. They're going to initially crash and come back or whatever. So you have the pre-recession trade where everything's hunky-dory. And then you get to this imminent recession crunch point. And a lot of times that happens around the end of Q3, give or take a couple weeks. Doesn't look like it's happening this year. We will see. I mean, things look bad in certain respects, but things have held together one more year. So then we start looking at end of Q1 and end of Q3 next year. We will see where this goes. Again, this month is very important. September was very important. October is also very important for these markets to see where they go heading into the US election. Does Trump make it to the election? If not, things are going to get wild. All right, so that's that. Let me check comments. No more comments. Let me check Telegram, see if there's any comments in there. Nothing in there. Well, guys, I'm going to leave you now for the weekend. Hope you had a great week. Hope you have plans for the weekend. Get out there and hug somebody that you love. Spend time with friends and family. Touch grass. Just went through the hurricane here in Florida. Very blessed to make it out with no damage. A couple people I know had property damage, but nobody was injured. So that is great. But things can go. We talk about Bitcoin, we talk about all this macro. We want to understand it and learn and be right and have predictions to set ourselves up for the future. But what we're doing this all for is for our friends, for our friends and family, our loved ones that we want to provide for and all that stuff. At least that's why I do it. So that's what's really important. Unplug for the weekend and, spend that time with those you love. All right. Like, comment, subscribe, jump over to YouTube and Rumble, join that channel and help me get to monetize that channel. And that's going to do it, guys. Thanks. Have a good one. Bye.